Morning everyone, welcome to Ainsley News. It's Friday the 6th of May. Last night continued the biggest share market whipsaw since peak COVID turmoil in 2020. After the biggest Fed day surge in 44 years on Wednesday night, last night saw the biggest drop since June 2020, with the NASDAQ down 6% and at its worst, and 5% at close. The S&P 500 was down over 3.5% as well, and to complete the reversal of all things, bonds tanked. Yields were up. And other safe haven of gold also fell back a bit to 1900 US, and the US dollar surged to wipe out yesterday's gains, but saw a much weaker Aussie dollar, and thus gold held steady in Aussie dollar terms. As usual of late, all this seems to be caused by the market trying to reconcile the growing consensus of long-term high inflation with more signals of economic weakness. Just a week ago, the US printed a negative GDP for the last quarter, 1 quarter away from recession. Last night, there was more poor data with US layoffs increasing, rising jobless claims, poor online retail sales data, and productivity dropping in the first quarter by the most since 1947. Again, stagflation looms large. This from Bloomberg. Doubts that policymakers can arrest runaway prices rocked markets, with the prospect of stagflation unsettling investors. By pushing back on a jumbo hike of 75 basis points in June, Fed Chair Jerome Powell beat back traders' most aggressive predictions. However, it's still a bumpy road ahead, with pivotal economic data and global developments that could seed doubts about the central bank's approach. Friday's job reports is expected to show solid payroll growth and wages holding at exceptionally high levels, remaining an enduring source of inflationary pressures. The stickiness of inflation is the key. Last night, US Treasuries saw a pronounced bear steepening, with 30-year UST cycle peak at 3.21% on concerns the Fed isn't doing enough to stop inflation, while speculation over fund liquidations grows. Remember, the long-dated or longer-dated bonds largely dictate mortgage rates, and the US is now looking at the highest mortgage rates since the GFC in August 2009. How could Aussie home owners fare? That gold went down last night might seem perplexing to those who understand it. Last night was simplistically an inflation-feared trade presenting as higher rates, particularly at the long end of the curve. There is an ingrained misunderstanding that higher rates are bad for gold. As we've written before, this is historically completely wrong, as the type of rising rates we are seeing are usually too little too late. And against rising inflation and an inevitable reversal on the indebted system breaking and gold outperforming every time. Gold sits nicely in the low to negative real rate space as an inflation hedge and safe haven asset on the inevitable outcome. Markets routinely initially get it wrong before piling in after the smart investors have bought early at lower prices. The cup and handle technical setup for gold supports this, and the same can be said for silver, which the following tweet from Crescat Tavi Costa so perfectly illustrates. This from him. If you didn't buy silver after one of the most short-term oversold levels in history, you will probably never buy something deeply undervalued in your lifetime. Great insight there from Ottavio. And that's news for today from Ainsley Bullion. If you are interested in checking out more news or purchasing today, jump over to ainsleyBullion.com.au. Interested in crypto, ainsleywealth.com.au, and goldsilverstandard.com for our own crypto products built and backed by real gold and silver. We'll catch you next week for more news.